How to start investing in the stock market. Hey traders, it's John Howell here, and in today's video I'm going to be talking about how to start investing in the stock market. I've got some new people who have joined my channel and people that are interested in like, okay John, I've been watching your videos, but how do I actually start investing in the stock market? What do I look for? What are some things I can keep an eye out for? And again, like how do I start investing in the stock market to start gaining some knowledge? So I'm going to talk to some people who are just looking to get started and what to do with that. So that's what this whole video is all about. Let's get straight into it. Don't place a trade based on what you'll see in this video because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. Alrighty guys, so obviously, people are looking to start investing in the stock market, and obviously with everything that's going on right now, there's obviously more people searching this and more people looking it up and more people coming across my YouTube channel because of this. So I want to do like a bit of a simple guide, a really simple guide to break it down into really simple terms of how you can start to invest or how you can start investing in the stock market, and some simple things you can look out for when trading the markets. So what I want you to do initially is that if you are brand new to the markets, or if you are new to the markets but you're still unsure how to start, or maybe you're just confused, then this is going to really help you out. One of the most important things to understand is how the actual market works, how the stock market works. And so how the stock market works is, and this will be wrapped around with how to invest in the stock market, is that the stock market works in waves. Okay, so we go wave up and a wave down and a wave up and a wave down. So if we're looking at, say for example, if we're looking at the markets, there is the psychology of the markets. Okay, and as you can see, on this chart here, it doesn't matter what chart it is, we generally have waves. We have a wave up and we have a wave down. We have a wave up and we have a wave down. And you can see a wave up, a wave down, and now we've had a wave up, and we still continue just slowly going through here. So you can see we have waves in the markets overall, and then a little bit of a wave up from here as well too. So we have waves in the markets, and how the markets work is, think about the markets as an energy field, right? As a whole, an energy situation. So maybe you go to the gym, okay? So think about the market as you go into the gym. And what happens is that if you go to the gym is like you're using a lot of energy, okay? So you start to use a lot of energy, you go to the gym, and at some point you finish the gym. Then guess what happens? You stop. What happens to your heart rate? Your heart rate slows down, you have a bit of a resting, you go home, you eat, and you have a little bit of a pullback, right? But because you've worked out, now what happens is that you pull back, and you might pull back your right rest, but guess what? Now your starting phase, or your next starting point is not down here where you first started, right? Why? Because you've already built some muscle memory, just a little bit of muscle memory. You've gotten just a little bit fitter, and then now that afternoon you came back and you had a little bit of rest. But now what happens is that because you're ready to go again the next day because you've had some good rest, you're now at this point here. So this point here, you're now ready to go, and from that point, you actually end up going higher than yesterday, just a little bit further than yesterday, and then you have a bit of a pullback, right? And then and the next day you come, and if you have a really good rest, you might even have just a little bit more rest, and it comes down to there, all right? And then suddenly what happens is, guess what? And then suddenly you go back the next day, but then suddenly you realize, oh my goodness, I'm starting to sort of top out, or I'm starting to peter out where I was yesterday. I'm using this as an example, right? Using where I was yesterday. So therefore what happens is then you start to get a bit tired, right? So then you say, you know what, maybe I need a couple of days off. And then maybe you need a couple of days off to start to have a bit of a rest. And so after a bit of rest, guess what happens? Now you're ready to go again. You may even get a bit pull back here. But now you're ready to go again. Now you're probably likely to break out and then go for another sort of stair-stepping phase once again. Make sense? So that's how the markets work in a nutshell. is that the markets goes up in an up fashion, and then the same for if you don't get off your backside and go to the gym and start to take care of yourself. Guess what happens? You say no the first day, and then the next day you're like, oh, well, maybe I should try, and then suddenly it doesn't happen, and then suddenly guess what happens? You know, you're on a downward spiral, right? You don't go to the gym, you don't take care of yourself, and it slowly gets worse and worse and worse. It's a bit of a downward spiral. So that's the way that you want to be looking at the whole stock market itself, is that you don't want to be confused. Now, there's so much education out there that's going to confuse the hell out of you that most of the stuff out there is not really important to your success in the markets. The most important thing to you as a trader is these charts here. Now, they may not mean something to you, or they may not mean much to you, but these markets is just a representation of, you know, how the markets work. And if I bring up, say, any stock right now, say such as Apple, all right? And so what I'm looking at here when I'm looking at Apple is, once again, I'm looking at the waves. All right? I'm looking at the waves, and I'm looking at to see what's really going on, because the market is always talking to us. And over the last 16 years of being involved with the markets, it's my job to always listen to the markets and to see what's really going on there. So what we're looking at here is and what we're looking at here, and what we're doing here is we're trying to see what? We're trying to see where are the waves, and the waves is going to tell us, you know, is there someone in control? Because you always want to be trading with someone in control. Remember, the big guys push this market around. So if the big guys are pushing this market higher, well, you want to be with the big guys. If the big guys are pushing it lower, then you want to be obviously with the big guys. You want to be with that trend. The trend is your friend until the end. And so if you have a look at, say, for example, a high and then a low, and then a higher high and a higher low, you can see the buyers are stair-stepping up in this in this example here, right? They're in an upward trend. So if you look at Apple here as an example, I'm just bring up Apple just as an example, you can see what? We can see the market rallied up, we had a low, then we had a big rally up, we had a what? We had a higher low, compared to this one here was also a higher low. Then we rallied up, guess what? We came back down, then we created what? This is also another slight little higher low. Then we've rallied down and come back up, and now we've created what? A slight little higher low. So as you can see, even though there's slight higher lows, guess who's still in control of this market? Say Apple or any market you want to look at. The buyers. Why? Because they're still raising their prices. You can see the buyers are still coming back in. If the buyers weren't interested in it, the sellers would knock it down like that. You get something like that, and then you'll start to get breaking, and you won't be getting these higher low points here. Higher low, or this example through here. So you can see the buyers, the market, the buyers itself in the markets are talking to us, and they're saying that the buyers are stepping back in every time that happens, and it's given us a reference point of what's going on in the markets. Now, what you don't want to see is that if the market's making let's do this here. If the market's making a stair-stepping fashion, and the market makes a higher low, as long as the market makes highs and lows, higher lows, then we've got the buyers in control, and the trend is likely to continue. But if you're long any stock, and then suddenly the market breaks down and it breaks this low here, guess what? We're no longer making higher lows, higher lows, higher lows. See how we've broken this point now? It's no longer making higher lows. If that ever happens, that'd be a risky time to start investing, because there's now indecision. It's not really going up. It's not really going down. Remember, what we're looking for when you're looking to how to start investing in the stock market, or if you're looking to take the confusion out of the stock market, we're always trying to find a point of where someone's in control. Because sometimes the market just goes sideways. Sometimes the market just does this for a while, where there's no one in control. The buyers are not raising it, the buyers are not pushing it up, and the sellers are not pushing it down. It's just sideways. In that situation, you don't want to get involved with that, because there's a very low probability, and a lot of people try to trade these sideways movements where you're not getting higher highs and higher lows, or a lower high and a lower low downward trend. This one here is more of a downward trend, as you can see, and this one here is more of an upward trend. But then you start to get sometimes when it's going sideways, like this point here, like this point here, and there's no one really in control. So it's lowered your probability of you having a successful trade in the markets. Now, also, when you're looking to invest in the markets, firstly, you want to identify where is the waves, where is the trend analysis. Then the second thing that's important when you're looking to start investing in the stock market is that you're looking to get in on one of these dips. So notice here with Apple, the worst time to buy Apple was, say, up here, and up here. Now, so there. So what you want to be doing is that you want to wait for the market to have a bit of a pullback. So you can see here, market rallied up, bit of a pullback. This was obviously a good time to buy. Now, hindsight's 2020, but you don't always get it right. But if you're looking to invest, you're looking to buy it on the dip first to give you a probability of it rallying up. And then as you can see, right, the market came down. And then as it started to pick back up, here was the point in time where you might want to start investing and get investing in Apple, because now we're starting to what? We're now starting to hold a base here, and we're now starting to pick back up. So if you're looking to invest in a stock you like, this is what you want to see. And as long as we continue to make higher lows, then I would say it's good to stay with that stock. Now, there's so many other things you can look at, okay? You can look at moving averages, you can look at indicators, you can look at all these different things. But the most important thing is the market itself, because the market is always talking to us. And over the last 16 years, gone through the whole 2016 election with Trump, gone through the whole 2008 stock market crash, and the whole vid situation in 2019, this year as I'm doing this recording, depending on when you're watching this and so on and so forth. I really have learnt the art of just really learning this here, and really learning what we can see here with these markets. So try to buy in on dip. And then the next thing I must say is that if you want to start investing in the stock market, that make sure you only have, I would say, no more than 5% of your account, on any given one position. So if you're looking to buy a stock, don't have any more than 5% of your account, especially when you're just first starting out, because you're going to make a lot of mistakes, and you're just getting used to reading the markets and reading the charts and learning how to read the waves. Then I would say no more than 5% of your account on any given one position until you start to get good at that. So there are the three rules that you can start to use when you're looking at how to start investing. If you're looking for how to start investing in the stock market, or if you want to start investing in the stock market, they're the three rules. One, you want to be looking at the trend analysis on the market itself. Notice I haven't got candlesticks and all that sort of stuff, because that doesn't matter to me. The most important thing is the market itself, because the market's always talking to us. Now, there's no guarantees of the market doing something, so that's the reason why we have this over here, right? So number one is obviously trend analysis. Number two, you want to buy the dip. So make sure we are in an upward trend, and then we just want to buy the dip. We want to make sure it has a bit of a dip. And if you're looking for a rule of thumb, just say this low point to this high point, measure say 50 to a 60% retracement. And then if you're looking for a good time to buy in on that dip, a 50 to 60% retracement seems like a pretty good idea with that there. Now, guys, I'm just using a general rule of thumb here. And then also number three as well too. Number three, also make sure you use 5%, because guess what? At the end of the day, you're going to have a win-loss ratio. And not every trade you get into, no matter how much you think it is, you're going to have losing positions. And so your idea is to keep these losses small. So if you just say, for example, you traded, let's just say you traded 30 times throughout the entire year, as an example. What you want to try to do is you want to try to set it up to where your risk on the risk on any position is your risk on any position, and your reward is like at least say 2 to 1. So you're looking for at least a 2 reward to 1 risk. Okay, to 1 risk. So say for example 5%, but your average stop loss or your average loss on that 5%, let's just say for example it's 2%, right? It's 2%, which means 2% by the time you actually got out of that. Now, where would you place a stop loss? the stop loss would be, say, for example, if I'm looking at Apple here, it'll be just below the low here. Because if the below gets broken, well, guess what? Now the market's no longer raising their prices. We're no longer in an upward trend. So therefore, it'd be a very, very bad time to stay in the market, because this could happen, and then you start hoping and praying. So try to have a stop just below the low, and whatever that risk is from there to there. If you did put, say, 5% of your account on, say, this stock, then that would be what? That would be, say, call it 10%, right? So that'll be 10% of that 5% position. So whatever that works out to be. You know what? Let's actually just use real numbers here for a minute. Say you had a $10,000 trading account as an example, and you put $500 on, roughly anyway, $500 on Apple, then your risk would be 10%. So your risk would be $50. You want to try to keep the numbers like that. The reason why is because when you have losing trades, you want to be able to go through one or maybe two or even three losing trades. You want to be in a situation where you can be 50-50 right, or in some cases, you may only be 30% right. Hear me out here. You may only be 30% right and 70% losses. But if you had that example, but then suddenly if you're trading $500, but then your average loss is, say, $50, but then now your average profit can be, say, 50% of that. If you just hold on, say your average profit can be $200. Well, now you've actually got what? You've now got 4 times. Is that right? 50, 100, yeah. 4 times to your risk over here. So you can see how that starts to really, really rank up. The whole purpose of this is that the risk's small because you're going to have losing trades. And every time you have a losing trade, you don't want to be hurting your account too much. And you'll want to set the game up to win. And how you set the game up to win is, one, go through what I've gone through, said today in today's video, when you're looking to start investing in the stock market. And then also what you want to be doing is you want to be keeping the risk real small, because you may get into positions, you may have 1 or 2 or 3 losing trades in a row, but then the 4th trade is a profit. And guess what? You may have trade number 1 might be a $50 loss. Trade number 2 might be a $50 loss. Trade number 3 might be a $50 loss. And before you know it, trade number 4 made you $200. And now, guess what? Now, because this one, now your account is actually up $50. You see what I'm saying there? And now I'm using small numbers, but you want to be in a situation where even if you have a couple losing trades in a row, that all it's going to take is just one good trade or one okay trade for you to be back in profit again. That's how you win at the game of trading or investing in the stock market for long term. And obviously, if you keep holding on, then some of these trades are going to go to 100% profit and a lot more as well too. So that's how. This is just a simple guide. If you're looking for how to invest in the stock market, or if you've contacted me recently and you're looking to invest in the stock market, here's a simple guide to get you started. Even if you've been involved with the markets for the last few years but you're confused, hopefully this video has given you some gauges or some guide to understanding, once again, how to invest in the stock market. Traders, I've been getting a lot of questions asking me about, John, how do I trade the markets? What sort of system do I use? What's my approach, and so on and so forth. So I'm running a free masterclass teaching you my #1 trading system for the last 15 years. This is the most powerful and highest probability system on the planet. And I'm going to just share with you all the details. Plus, I'm going to share with you how I find and scan and do all my trading in 1 hour or less per day. If you go to johnsfreetraining.com, you can register for this free training that I'm going to run. So go to that right now. I'm going to teach you all the details, and I promise you, once you leave this free training, not only will we know exactly what goes into a good trader, so you could be a good trader, but also you're going to learn my #1 trading system, all the details so you can start to crush it. So go to johnsfreetraining.com, and I look forward to seeing you on the masterclass. Go to johnsfreetraining.com right now.